Howdy who, all my stock market gamblers. Welcome today. I'm Tall Mike. So glad you're here. Well, it's Friday. We made it to the end of the week. What's going on today? Dow's down about 200. NASDAQ's up about 80. Kind of a mixed day in the market, a little bit to the downside. Amazon came out with better than expected earnings, sending the NASDAQ up, but the Dow is down, right? All right, but we've had some great news come out, right? The economy's booming. The GDP numbers came out almost 5%, 4.9%. And inflation numbers came out, and prices are starting to cool. This is great stuff, right? It's not quite how I see it. You might have guessed that already. Look at the GDP number at 5%, right? All right, so we got inflation, true inflation, running about 10%. So it's really running about half of what inflation is. Okay, and if you take out the spending for war, take out the government deficits, take out the printing of money, you actually have a negative GDP print right now. Look, at 64% of Americans are living paycheck to paycheck. 50% of Americans don't have $1,000 saved up for an emergency. These are not the best of times. Delinquencies on auto loans, credit cards, mortgages are skyrocketing. This is not a booming economy. Prices are not starting to cool. Prices are still going up. Starting to cool? I would think that means that prices were coming down, but prices are still going up. Now, what do I think is going to happen with the stock market? Look, we've had this downward pull now, right? We're down below the 200-day moving average. And if we don't get back above that real soon, there's a lot of room to the downside. Now, what do I think is going to happen? I actually think we're going to get back above the 200-day moving average. You see, it's a question. Are we going to crash now? Which is possible. I'm not saying I'm taking that off the table. Or are we going to crash later? Can we push the crash out until next year? I think they're going to push it out later. Now, the reason I say this is the HYG. You'll notice the S&P coming down, making those new lows, right? But the HYG is not making new lows. It's divergence with the S&P. It's actually gone up a little bit. So I think that's going to pull the S&P higher. If we were going to get a crash, that HYG would continue to just be making new lows along with the SPY. But because they have a divergence, I think we're going to get a bounce from here. I think we're going to get a run up into the end of the year. We'll see how this plays out. Your take may be that we're going to get the crash now. It's not off the table. There's a percentage chance that we're going to have a Black Monday. Now, I don't think we're going to have a Black Monday, but we're still in the month of October where those typically happen. We got one more Monday left in October, but I don't think it'll be a Black Monday. I think we're going to get a bounce from here, and I think we're going to head higher into the end of the year, and next year I think we will see a crash. Just my take. Your take may be completely different. Let's get over to the real estate market and talk about that for a little bit. Great news, great news. New home sales. They soared, right? They soared. And guess what? Buyers are now swarming the market. Hurry up and buy. Look I don't quite have this same philosophy as they do. Now, when this news came out about new home sales soaring, what did the stocks do of the home builders? Well, Lennar, Toll Brothers, Poultry, they all dropped on this news. Why they drop on this news? Well, this goes back to August, right? Goes back to August, all the way back to August. What month are we in? We're going into November. Look at things have changed. And the article did say that demand in October has become a little bit more choppier. I'm not sure what choppier means, but I think it means we're going to head down lower soon. Once again, just my take. Now, 16% of people that went in and bought homes backed out of the homes. Why'd they back out if everything's so great? When they want to lock that up, well, maybe they couldn't qualify for the loan. Maybe they watched my video and said, oh my God, I don't want to buy a house now. Tall Mike thinks houses are going to go down by about 40 to 50%. That's what I believe, but that's that's not what everybody else believes. Now, existing home sales, they're falling off a cliff, down 20% year over year. But these new home builders, they're a little bit smarter, right? Now, they reduced the prices across the nation on average 14% already from the highs. From the highs where Billy Bob sold at, where he got out, the new homes have already reduced their price by 14% nationwide. Now that's interesting to me because you see, here's the thing. It's not just 14%. It's not. Look, they're giving concessions, right? They're giving you the granite countertops. They're building the swimming pool in the backyard. But here's the big concession. They're buying the mortgage rate down from 8% down to 5.75%. And that's costing them $10,000, $20,000, $30,000, $40,000, depending on the price of the home. So this is a big concession. So we're down much more than 14% on new home prices, but we got a lot farther to drop. Sit back and watch the show, right? Now the realtors are out there. They're all out there telling you, hurry up and get off the fence. You got to hurry up and buy. You got to lock in this mortgage rate at 8% before they go higher. Now, I agree that mortgage rates are going higher. When mortgage rates were at 3%, I said we're going to see 10% mortgages. You know how many names I got called? They said, but Mike, that's impossible. That's not going to happen. Well, we're at 8%, and I think we're going to hit 10. Actually, I think we're going a lot higher than 10. Now, that's shocking, but Mike, we can't go higher than 10%. House prices would start to collapse. Yes, they will. I'm afraid they will, but we're going to go higher than 10, higher than 12, higher than 14% mortgage rates. We're going to hit up around 16 to 18%. Now, you can tell me I'm crazy. Everybody will tell you I'm crazy. Read the comments. But, Mike, we're going to come down to 5%. The Fed's going to pivot. Now, the Fed may pivot, but mortgage rates are going higher. Can I tell you why? Can I tell you why? We got a little time. It's Friday. Let me tell you why. All right. So it's the banking system. You see, people look at this, well, let's go. It all started back in 2008, right? The subprime and the banks, they collapsed and they needed the bailouts, right? Okay, we're much worse than 2008. Look, in 2008, we didn't have this big debt. We had debt, about 10 trillion. We're at 34 trillion now. 2008, the Fed didn't have this big expanded balance sheet. The Federal Reserve didn't go out and buy everything. It was about 1 trillion. It's over 8 trillion now. Okay, so things are much, much worse. The bubble's much, much bigger. But here's why we're going to get those mortgage rates going up. Here's why the home prices are going to come down 40 to 50%. Yeah, we may get a dead cat bounce here. Look at, new home sales. They're soaring. Hurry up and buy. But okay, here's what's going on. All right, so a lot of people don't know what the bank term funding program is. Bank term funding program. All right. Silicon Valley Bank breaks, right? And they don't want a bank run. They don't want every bank breaking with Silicon Valley Bank. You see what the bank does, they take your money and then they put your money into, let's just call it bonds. They bought a lot of bonds. Did they buy short-term bonds? No, they bought 30-year bonds. These banks, they bought all these bonds. How stupid could they be? Well, that's what Silicon Valley Bank did. But you see, they weren't the only bank. Every bank did it. Every bank went and bought these bonds for 30 years, right? And these bonds, because they've raised interest rates, have lost about 40 to 50% of their value. So all the money that you have on deposit, well, that's wiped out. 40 to 50% of it's wiped out. Now, does the FDIC have the money to replace that? No, they do not. They do not have the money to replace that. So, okay. So what the Federal Reserve did, anyways, they come out with the Bank Term Funding Program. Saying that the banks can take their bonds, okay, it'd be like if you bought Apple stock, right? And Apple stock dropped, and Apple stock's dropping right now, down below the 200-day moving average. But anyways, okay, so Apple stock drops, but you don't have to take the loss. You just go to the Federal Reserve and they're going to give you the whole 100%. Even though if the stock's down, let's say the stock dropped 50%, doesn't matter. Federal Reserve is going to give you 100% of your money back. That's what they're doing for the banks. The bonds have dropped by 50%. Doesn't matter. Take the bonds, give them to the Federal Reserve. Federal Reserve gives the bank 100% of their money. Okay, now why are they doing that? Because they don't want the banks to collapse. The banks would be done. There would be a run on banks. The system would already be down. But here's the thing. Okay, so the Federal Reserve is doing this. Now this program comes to an end next March. Started in March with Silicon Valley Bank problem and supposed to last a year. Now they're going to have to extend it. Any federal program that's temporary always becomes permanent. That's just how the government works. They don't have a plan. They don't know what they're doing. But okay, so the Federal Reserve is giving the banks 100% on these bonds, right? Well, okay, but here's the problem. Okay. Now, this is a choice, and the Federal Reserve is in a really bad spot right now. They can keep doing this and keep printing money unlimited to a tune of about $17 trillion is what they'll have to do to buy all these bonds back from these banks. There's a big hole in the banking system right now, very fragile. But okay, so when you get people come into the bank and you go in and you want your money back, they go, oh no, we're running out of money. We got to take more of these to the Fed. Well, the Fed's not going to take them anymore unless they want to print 17 trillion. That is an option. What we got to do? Well, we got to sell the bonds. We got to sell the bonds we have left. But the question is, who's going to buy them, right? Who's going to buy them? The bonds have become illiquid. Never would I think that the bonds were illiquid, right? There's so many bonds, but there's no buyers. It's like the housing market. The housing market's become illiquid. That's why there's no transactions. It's frozen up. There's no buyers, right? The bond market is illiquid. There's no buyer for these bonds. So what happens to the bonds? They drop even more in value. When bonds drop in value, what happens to rates? Rates go up, rates skyrocket, and we're talking they're going to pass 10%, maybe past 15%. What will that do to mortgage rates? Mortgage rates are going to skyrocket. They're not going to stop at 10%. Now, when we were at 3%, I was calling for 10%. People told me I was insane. People called me all kinds of bad names. Read the comments. It's funny. Oh, some people don't like me. I don't know how that's possible. I mean, me and you, we come to this channel to talk. Other people just come to this channel to be a troll. I got a lot of trolls out there. It's kind of weird, right? Why don't they just change the channel if they don't like it? Why would you come and listen to Tall Mike if you think prices are going to keep going up? Why do the Moon Boys come and listen to me? I don't know. I really don't. But what's going to happen is there's nowhere to sell these bonds. The bonds are going to just free fall. Rates are going to skyrocket. Mortgage rates will surpass 10%. 10%, probably hit 12, 14, 16%. Now, of course, this is not going to affect homes in your area. Your area prices only go up, right? But in most areas, this is going to affect the housing market. The housing prices are going to come down. Now, it's weird. I do agree. This is a little strange. We went from 3% mortgages up to 8% mortgages, and the prices have barely come down. Only about 15% down in my area. And I know your area, that made prices go up higher, and that's perfectly fine. You live in a great area. So maybe when we hit 16, 18% mortgages, prices in your area will be up to the moon. That is a possibility, I suppose. But in my area, when we hit 16, 18% mortgages, we're going to be more than 40% off. We'll probably be 50 or 60% off. This is not going to end well. The bond market is going to free fall, and that's going to be caused by a run run on the banks. Now, if you notice, they're not talking about this on mainstream media. Right now, there's kind of a revolt going on. People are quietly pulling their money out of the banks, and the deposits are dropping at the fastest rate in history. Deposits are going away. The banks are running out of money. What are they going to do? They're going to sell the bonds. Sell the bonds, but to who? To who? Do you want to buy government debt for 30 years? I don't. I know I don't want the government debt. Government can't pay the debt back. People are starting to wake up to this. Protect yourself the best you can. Now, I say the best you can is to pick up a little bit of gold, pick up a little bit of silver. The moon boys are going to pick up that Bitcoin because that's going to the moon. And that's possible. I'm not saying Bitcoin's not. Maybe it will. It's just not for me. I'm an old guy. I want gold. I want silver. That's where I think the protection is. Protection against the dollar. Protection against the collapse in the bonds. Usually when things, we're at, 2-3 wars right now. I don't even know how many wars are going on. But during times of war, people fled to safety. And that used to be the bonds. But right now, the bonds are the most risky place you can be. They can free fall. Yes, the Fed can they can print all the money they want and buy these up. But then we hyperinflate. You hyperinflate, what's going to happen? Oh, it's not going to be pretty. There's not a real good solution right now. We're in quite the conundrum. We have a problem in the U.S. It's not just the U.S. It's worldwide. The real estate bubble is worldwide, the largest the world has ever seen. The debt bubble's worldwide. I mean, over 300 trillion worldwide debt. And then when it pops, it's going to... I don't know how it's going to look. It's not going to be pretty, though. I'll tell you that. Now, I know it's Friday, and I always get carried away. I bring the scary stuff out on Friday because we got Halloween coming up. If you like this stuff, give me the thumbs up. Why not? I'm Tall Mike. Get out there, everybody. Have a great weekend. Punch the subscribe button. I want to talk to you next week. Bye-bye now.